Thanks for tuning into the All Funds Network podcast. My name is Mike Schroeder, here with my co-host Steinke, and we are joined by Nick Santomauro, CMO of Figure Markets and former global head of growth at Binance. Nick, thanks for joining us, man.
Thanks for having me. I'm excited to chat.
Likewise. Got a lot of fun topics lined up here today. We're going to talk about stablecoins, talk about a little bit about exchanges and some lending. But maybe let's start with the stablecoin side of things. So you guys have recently launched your own stablecoin. Maybe just start with that. Kind of what's the story there? What are you guys seeing in the market?
Yeah, so it's called Yields, and it's the first freely transferable with KYC yield-bearing stablecoin that's SEC registered at this point. So we're really excited about that. That was let go effective in February. And, we've kind of been building out infrastructure ever since and trying to get deals in place. There's some big exchanges on the horizon that might be allowing it to be used as collateral. If you kind of think about stablecoins being used as collateral, it's not that any different from USD. You still have to pay the full margin cost. But if you're using a yield-bearing stablecoin as collateral, it essentially brings your margin cost down, right? So like if the stablecoin is giving out 4% and margin was at 10% before, now you're effectively only paying the delta 6%, which makes margin that much cheaper. And that actually might add some more leverage into the system.
Maybe with stablecoins. So like what's been like, what's happened in stablecoins? Maybe just start, kind of, obviously we started with Tether years ago. Kind of what's led up to where we're at right now and kind of, what really differentiates that product you guys have?
Yeah, I don't know how far back to go, but I remember when Tether first came around in the crypto space, and it was just such an obvious need of, being able to trade in and out of Bitcoin and like ETH at the time, right? And that finally gave you the ability to, because everyone still had that mindset of like, I want to grow my USD stack, right? And I think now or recently it's more, I just want to grow my Bitcoin or Ethereum stacks. I don't care what the USD value is anymore, right? Like I want to get out of USD. So I think that was the original kind of thought of where Tether came from, and then Circle launched USDC. That grew huge, and I think they kind of played up the trust factor. And then when I was at Binance, we actually launched BUSD, which had gotten kind of massive. I don't know if you guys remember, it got up to like 15 billion in TVL.
Yeah.
And I think the big reason why was because we were offering zero fee trading if you traded Bitcoin or other coins against BUSD. And so a lot of people were switching to that as their stablecoin of choice. And then, that the whole CZ thing went down and BUSD went away. And then you kind of just, jump to today. There's BUIDL from BlackRock and USDY out there. Those are essentially just tokenized money market funds. And so Yields is the first SEC registered freely transferable security, right? It's an actual security token. And so that means that banks can hold it. That means that as long as you're KYC'd, you can freely transfer it, right? You can use it in pairs against BTC, against XRP, like you have on Figure Markets right now. So we were the first ones that did that. We used, the legislation that was already on the books from I think it was 1940 rule or something like that to create the security. And so we think we probably are the only ones that are going to be doing that for at least 6 to 12 more months, something like that. And kind of in the meantime, the Genius Act is going to pass, which does not cover yield-bearing stablecoins. Right. It only covers non-yield-bearing stablecoins, right? So you'll see JP Morgan coin, you'll see bank coin, right? Those will just be all stablecoins. But I have a big theory on that we could talk about in a little too.
Yeah.
And what's kind of interesting, from this perspective is what's been done, or at least from my understanding, what's been done historically is, company like Tether, they're issuing these tokens, they're keeping that yield for themselves. So you guys are actually giving this yield back to the users. Yeah.
Yeah, that's exactly right. So if you're holding yields, you're getting SOFR, which is the Fed's overnight rate, minus 50 basis points, which is our cut essentially. Mm-hmm. If you look at USDC or USDT, they are essentially doing the same thing of buying short dated paper on the back end, so that they're making money on it, holding it for you while you use the stable coin. But the big difference is they don't pass that yield on to you at all. They keep it for themselves, right? USDT fully does. USDC kind of gives it back to you because of their partnership with Coinbase. which I think is like kind of like a workaround for them on making it a yield bearing stablecoin. But one, you have to keep your USDC on Coinbase, or two, you have to use Coinbase wallet. So it's not like free, like a free yield bearing stablecoin in effect, or freely usable. So, that's kind of what we think about yields. Is this is the first yield bearing stablecoin that's SEC registered. You can use it on any platform and get the yield, not just Coinbase or Coinbase Wallet. And it lowers margin costs when you're using it on other platforms. Which, like I said, we have some big deals in the works there.
Yeah, that's pretty exciting. Like you mentioned, banks as kind of one audience out of the gate. Now we can talk about kind of the bank process as well. I'm just curious, like the other audiences you guys are going after, is that your first kind of push into more of a banking side of things, or where do you want to go from audience perspective?
We're kind of just throwing like a huge blanket out there right now. We ultimately think everyone will want to use this. And so exchanges, DeFi wallets, right? Like if you're a MetaMask or Phantom, you don't have access to USDC paying out yield like Coinbase Wallet does. That's unfair, right? So like partnering with them, maybe we'll do something like that. The bank side is going to be very difficult and a much longer process, because the yield-bearing stablecoins actually are antithetical to how our current credit system works, right? And the way banking works. They take your cash in a savings account and then they lend that out, right? That's how our credit system works. If all of a sudden everyone is holding yield-bearing stablecoins on their balance sheet, or in their accounts, or they remove them into like a DeFi ecosystem or a Web3 ecosystem, all of a sudden trillions of dollars can leave the banking system. We might see a huge credit crunch.
Yeah, that's actually a great point. Bringing up the fractional reserve system as it is, right? It wasn't made for this type of process, shall we say?
Exactly.
Right.
Yeah. I mean, think about what's going to happen so we have a big white paper coming out on this soon, which I'd love to send to you guys after. But basically what's going to happen, we think, is the Genius Act is going to pass, and there's going to be a huge proliferation of stablecoins everywhere, right? Now, banks have two choices. They can either let capital flee the system, because now Starbucks takes, stable coins or whatever. And it's like, why even have a bank account anymore? Or they can kind of just become a wallet themselves and have stablecoin infrastructure on the back end. But even if that happens, they have to buy short dated paper to back it, right? And that's less money to lend out. So we had this personal story back in, I think it was 2023, when Silicon Valley Bank went down. Like $1 trillion left the capital world at that point, the reserve banking system in that world. $1 trillion did that, and we had issues. We had credit issues here at Figure, giving out additional loans for like a couple of months because like it was very hard to come by. So that was when $1 trillion left. Imagine if $6 trillion leaves the banking system, right? Like there's going to be a problem, regardless of which reaction the banks take, either becoming a wallet or going the yield-bearing stablecoin route themselves. There are things that are changing, and I think the DeFi ecosystem is going to be there to pick up the pieces.
Yeah, that's really interesting. I'm curious to see. Kind of, to your point, obviously that was a tough time with SVB and all that happened. With the stablecoin scenario, in addition to the what you just talked about, kind of just issues with the banks, the speed at which the transactions happen is getting faster from a stablecoin point of view and settlement point of view. So that can even create further faster run of the banks. Maybe people don't realize that scenario. Yeah.
It's going to be a very, I think, awkward transition phase from our current, reserve banking system and credit system to one that needs to kind of be fueled a little bit, or at least the slack has to be picked up by DeFi a little bit.
Mm-hmm. Now, with two more questions on your token, how do you get the yield in terms of, if I own one of these tokens, after a year, do I have 1.4 of these tokens, or does the token itself kind of go up in value?
So right now you can only get, just where we're at with development, we only had the token for like 4 months. You can only get it on Figure Markets right now, and then we just credit your account if you hold it.
Okay.
We are exploring other things like in DeFi and like wrapped yields or KYC with like, wallet, like a MetaMask or something like that. But those are just all really preliminary plans. We still have to get, approvals and all of that to do it. So if you want yields right now, you have to go to Figure Markets.
Hold it in the app. Yeah. And then the KYC aspect. So I get some of these tokens. Could I just send it to Skyler, or just could I only send it on the Figure Market app right now? How's that work?
Yeah, you can send it as long as you're KYC'd on Figure Markets. You can send it peer-to-peer on Figure Markets, or you can send it peer-to-peer on Provenance blockchain, which is where Figure Markets lives.
Got it.
So for your audience, if those don't know, Figure Markets is an exchange. It's a borrow lend pool, and we also do crypto-backed loans, and all of that lives on Provenance blockchain. So it's kind of a mix between a centralized exchange, a decentralized exchange, and a hyperliquid. It's like all that together in one.
When it comes to yields for stablecoins, how do you see this kind of progressing over time?
Yeah, I mean, the head start on non-yield bearing stablecoins is massive, right? Like between USDC and USDT, it's what, like 200 billion right now? I don't know, some massive number. I think that number is actually going to be very small relative to, now when JP Morgan coin comes out. I mean, that could be, billions overnight, right? That could be potentially trillions as a ceiling, especially if all banks go that way. So my general hunch is that non-yield bearing stablecoins are going to proliferate very quickly, very, very quickly. And infrastructure will be changed all over the world because of those non-yield bearing stablecoins proliferating so quickly. I think ultimately, though, if people get a whiff, or when people get a whiff of yield bearing stablecoins, why would you ever hold a non-yield bearing stablecoin instead? Right? Like that's just it makes no. So I think over time it'll be a better mousetrap, and all of that non-yield bearing stablecoin liquidity will eventually flow into yield bearing stablecoin liquidity. And I would imagine at some point banks will either be forced to react, or there will be non-banks that kind of lead the space with the non-yield bearing with the yield bearing stablecoin transition.
Yeah, it's pretty interesting. You think about, like you said, obviously you guys are, this is an arms race for you guys. You're already out there. You have your yield coin, which is pretty cool. But it just essentially where crypto's at today, even like just the banks itself, as you mentioned, savings in a bank, it's not very sexy, right? We get a 0.05 or whatever it is, maybe 5 bips. Yeah. And now you have created a new mechanism, new product that's easily accessed at scale, right? Whereas DeFi, and eventually DeFi will play on that, as you mentioned. So that's pretty interesting paradigm.
Yeah, I agree. Yeah, I think where it's going, and we've created another product for this, which someone said on Twitter the other day that like we're playing both sides of the fence, which I think Mike Cagney, our CEO, is like, I'm not that, that thoughtful about the future and playing both sides. But it kind of is that way. So we have this borrow lend pool called Democratized Prime. And democratized means we're democratizing it for everybody, right? Everybody has access. And Prime is prime brokerage, right? That's like a financial services term. But then also the prime rate that like banks are able to lend to each other. And it's almost kind of, I don't want to say risk-free, but like lower risk, right? And retail does not have access to the prime rate today. And so what we think is going to happen is we think there's going to be a capital fleeing the reserve credit system, right? And what we think is going to happen is everybody will still need credit, and they'll take their stable coins and then they'll lend like a bank in these borrow lend platforms like an Aave or like Democratized Prime. And so we've on the lending side of our business, a Figure, we're currently putting about $600 million worth of home equity loans on chain, on Provenance. And we're really the only company in the world that has used blockchain to disrupt an industry. There's like $12 billion worth of outstanding home equity loans on Provenance right now. I don't think people know that. If you go to realworldasset.xyz, you could actually see all the TVL there. We're by far and away the largest real world asset player in the world. And what we're doing is we're taking some of those loans and we're putting them in a borrow lend pool. And so we're using them as collateral to borrow against. And you as retail or institutions can now lend cash directly against those, right? So we lend out at about 9.5% home equity loans. And then you as a retail investor can go lend against those assets and get 9%. So we're taking home equity interest payments and we're just essentially passing them on to you. So then we could take that cash and then lend even more home equity line of credits out, right? And so that's the way we think that the credit market is going to get replaced by DeFi, where instead of banks being the only ones to lend out new loans, now you can lend out for new loans against real world cash flowing assets that are already out there.
Yeah, let's maybe kind of walk us through that business. So you guys started this years ago, as you mentioned. It's on the Provenance blockchain. So you guys are doing home equity line of credit. Kind of maybe just start by just explaining to people like what is a HELOC?
Yeah, for sure. So it's a type of mortgage, if that helps folks. And basically, let's say you have a house, right? You own your home, and you want to build a new pool in your backyard, something like that, right? And let's say you own your house outright. The pool costs $100,000 to build. You take out a home equity line of credit, which is essentially you drawing down on the equity in your house, and we or banks give you cash for that, right? And then you pay some interest monthly in order to, fund the pool purchase. Let's call it 8-9%, whatever it is at today's rates. You build your pool, you have fun in your pool, and you essentially just drew down equity from your house.
Mm-hmm.
Right. And so we've been using Provenance blockchain to issue those home equity lines of credit since 2021. And because we're using blockchain to settle all of those loans, we've removed middlemen from the equation. And because we remove middlemen and rent seekers from the equation, we're able to undercut rates in the industry. And we went from $0 worth of loans all the way up to $12 billion in outstanding loans, which you could see on Provenance Pulse.io in 3 or 4 years. The business is kind of skyrocketing right now. And so what we do is we give out those loans. And today we're getting the capital to give out those loans from what's called a warehouse line of credit from one of the major banks, right? And what we're thinking is that we're going to use democratized prime, that borrow lend pool I was just talking about, to replace that centralized bank warehouse line of credit. And then we think that rate will be even lower, and then we'll undercut the market even more. We'll give out even more loans.
So when you say undercut the market, by how much from a traditional HELOC to what you guys are envisioning?
I'm not sure where the rate is going to clear, because what's going to happen in the borrow lend pool is, retail only has access to the overnight rate, SOFR right now, right? And that's like what, 4%-ish, maybe you get 4.5, something like that. And so the prime rate is currently about 7%. So as long as we get underneath the prime rate, then we're going to be able to undercut the market even more again, right? And we think that retail is going to be happy to undercut the prime rate, maybe 6.5, right? 6.75, something like that, because that's still almost 300 basis points higher than the overnight rate, the Fed fund rate, right? So we do think that retail is going to be thrilled to have access to higher kind of low risk rates. And so wherever that supply demand ends up netting out, that's what we're going to use that delta to undercut the market and, kind of further those 12 billion of loans outstanding and keep going.
Mm-hmm.
And the way you can kind of think about this too is that makes democratized prime kind of turn into a decentralized warehouse line of credit. And so imagine if we work with a SoFi and they put their student loans up for borrow, right? Or we work with Toyota and we put their car loans up for borrow, or you name it, right? All of these different borrowers, and you could just lend out a portfolio of loans like a bank does today.
Yeah. And I kind of know this since we, had our last call, but you mentioned you guys kind of launched the exchange really on the back end of the loan side of the business. Kind of talk to us about how these types of business kind of collaborate together.
Yeah. So the way we kind of think about it is one, out of convenience. So if you come for, because you want 9% on our democratized prime, which is the current rate, stay out of convenience and do your trading on the exchange, right? That kind of thing. But we also envision a world where, one, you'll be able to just trade all the tokenized debt directly on our platform, right?
Mm-hmm.
If you're lending against it, you could also trade it. And then once, stocks are on chain, all of that, you'll essentially be able to cross collateralize all different types of tokenized assets into democratized prime. So imagine a world where you put up for borrow your Tesla stock. Let's say you have some T-bills you put up, you put up Bitcoin, You take all of that cash that you just put up, and then, you buy some NVIDIA or something like that. So we think blockchain is going to be this massive unlock for cross-asset, cross-collateralization. And that's why we have an exchange too. But that's like phase 4, phase 5, right? Like that's further out there. That's kind of when everything is fully built out. And that's the ultimate goal and ultimate vision. But phase 1 is democratized prime. Come lend like a bank, get 9% today. And then there's going to be more and more borrow pools and more assets on chain, and we'll just keep growing.
Yeah.
That's really cool.
Talk to us about kind of like the appetite that you guys are seeing from borrowers out there. Obviously you mentioned 12 billion, but kind of, I'll let you take it how you want.
Well, the HELOC side of the business, the lending side of the business is kind of going crazy right now for 2 reasons. One, ever since COVID, home equity values have skyrocketed, right? So people are sitting on a lot of home equity that they just want to take out against and do stuff to their house, especially because they can't actually leave their house because mortgage rates are so high right now, right? So it's like a way cheaper alternative to just improve your current house. So demand for home equity lines of credit is through the roof right now. The other side of that is we have essentially a B2B business where you can come use our loan origination system and cut out middlemen, settle on Provenance blockchain, but bring your capital to fund loans to your own customers, which of course we take a cut of. So that B2B side of the business is massive right now and it's driving huge growth. And so when you can kind of combine both of those together, the HELOC side of the business is just such a massive current business, and it has a massive growth opportunity in front of it still.
Yeah.
Yeah.
Couple questions on that. Well, coming back to maybe the borrower side of things, just from an audience perspective, what is the experience using a Figure HELOC in the process versus a traditional experience? Same? No difference?
Yeah, I mean, you can barely tell a difference in terms of like user experience. We completely obfuscate the process for you. But the best thing is that, it's just almost, it's like so much faster than everything else, and it's so much cheaper than everything else. So you have this experience that's faster. You have this experience that's cheaper. We have, a trust pilot review of like 4.8 that we just hit today. Our customer service is kind of through the roof. So you've combined a, familiar UX with cheaper and faster and great customer service and that B2B marketplace. And that's how you disrupt an industry.
Yeah, that's really cool. I mean, I guess on the B2B side, as you mentioned, that's an interesting play. Almost, do you guys see yourself as like a de facto protocol layer for lending infrastructure?
We do.
Okay.
Yes. And that's actually, so democratized prime that I just talked about is basically fueling that B2B marketplace or the D2C side of the HELOC business. It could be its own thing, being a decentralized warehouse line of credit. But if it doesn't end up being that and just ends up being fuel for the home equity loan side of the business, that's still a massive win for us too.
Yeah. Talk to us about scale. How big do you think this can get? And how, maybe kind of like your roadmap. Like how do you continue to grow this?
I mean, the aspirations from both sides of the business right now is we want to completely win and own tokenized debt. And so we would love to be by far and away not the only, but the largest, loan originator in the space. We would love to be the place for decentralized warehouse line of credit. If you kind of combine both of those TAMs and both of those opportunities, it's hundreds of billions, if not trillions. It's actually probably trillions of dollars worth of opportunity. People always kind of talk about Robinhood and Coinbase and how they're tokenizing equities, that kind of thing. We're the only ones talking about tokenizing debt, and that's a much bigger TAM. And we have a massive lead right now with the B2B marketplace, with $12 billion outstanding. We've actually unlocked $16 billion. We're putting 600 million on chain every month, and that's growing 40% year on year. So it really is just, we need to execute. We need to, keep being innovative, and the space is kind of ripe for the taking right now.
And obviously over the last couple of years, private credit's been a huge investment, especially for family offices, institutions, high net worth businesses. Do you guys, see yourselves kind of penetrating that market as well?
We do. Yeah. I mean, one of the biggest I guess, superhero traits that we have at this point is we have a series of channels through like independent brokers and then licensed brokers, where they're using that kind of B2B business, right? No one else has those connections. That is a huge moat. So the fact that we're originating or settling all these loans using blockchain is a huge moat. We already have all the infrastructure set up. And the fact that we have all these channels set up and partnerships set up is another huge moat for us too.
Yeah, that's actually, those are important points. And maybe this may be helpful to talk about this. You can maybe explain to the audience just what the traditional process is from the manual credit process, right? Versus how big of a seismic shift going on chain really is.
I mean, I think the easiest way to summarize it is we've removed 125 basis points of frictional cost, right? That's how many people had their hands in the middle trying to facilitate settling and originating these loans, right? If you were taking out, an 8% loan before, and this is just back in the day before Figure came around, we were able to give you 6.75%, right? Like that's the kind of tectonic shifts that blockchain has enabled, because everybody that has their hands in the middle reaching out saying, I want my cut or whatever, those hands no longer exist.
Yeah. And to your point, you made it for the user experience, it's seamless. Nobody sees the blockchain.
You can't even tell.
Yeah. When people say blockchain, they kind of think it's a different experience. And really it's not. It's just the rails, the infrastructure you've used to build the connectivity.
Exactly. And I think, like one just like kind of side thing is, and it's a novelty, is like you could also see your loan and your loan details on chain, right? You could see where it is, who owns it, all of that stuff, which is, I think, actually pretty cool, because today that's a complete black box.
Well, it provides a level of transparency that never was out there before in the private market space, right?
Exactly. I mean, like think about like the 2008, 2009 financial crisis with MBS and CDs and credit default swaps, right? That happened because nobody had any clue how much leverage was in the system, right? Imagine if the entire mortgage and HELOC industry was on chain. You saw how many credit default swaps are out there. You saw the leverage in the system. People would just be deleveraging if they saw it got to a crazy level. It wouldn't have never gotten to that level that it got to. And that's all because of transparency of blockchain.
Yeah, great point.
Yeah. When somebody takes out a loan, are they getting stablecoins or are they getting cash?
Not today. They are not getting stablecoins, but we do have yields. So I can't say that how far along those plans are or are not, but they've been discussed.
We got to talk a little bit about the Genius Act. So you kind of alluded to it earlier, but kind of give us your high level thoughts about this. Obviously, as you guys are building out a stablecoin, it's something that I'm sure you guys are all over. You got your eyes on. What are kind of your high level thoughts and how you think it'll impact the industry?
We kind of talked about the credit crunch that's probably coming. I think that's huge. I think what we haven't talked about on the Genius Act is all the positives, though. We were talking about Tau before, the BitTensor, before all this got started, before we started chatting. And I wanted to buy more recently, and I had cash in my Morgan Stanley account, and I had to sell some stocks. That took 3 days to settle. Then I wanted to send it over to my bank account to get into Coinbase, because that's where Tau is the easiest to buy right now. That took another day to get the cash into right. Like, so by the time
it's already up 30%.
Yeah, it literally ran like 30 or 40% in that time. Wow. Exactly. And I can't wait for the entire world's infrastructure to be running on blockchain, and stablecoins are going to be the first thing that the world gets used to, right? And so I think that's going to drastically increase the efficiency of the world's economy, right? Like if settlement was taking 3 or 4 days before and now it's instant, that has to drastically increase the efficiency of the world, and that will lead to gains of productivity or whatever you want to call it, right? And eventually that's going to be a gateway into the rest of the decentralized ecosystem, right? Like DeFi, like that kind of stuff. And so I think ultimately it's going to be there will be huge positives in infrastructure and efficiency. There will be huge positives in terms of crypto onboarding, DeFi onboarding, that kind of stuff. And it's just a matter of, as long as you can handle the the bank exodus or credit crunch side of things with DeFi replacing it, the Genius Act has the ability to really supercharge the world's economy. And it's also really interesting what could happen too on the U.S. dollar side. If you kind of look at how big the deficit is right now and how big the debt is, 31 trillion, whatever it is, 36 trillion, I don't know. A lot of that, let's just say, stablecoin, USD stablecoin adoption skyrockets. A lot of that will be banks or whoever else issues the stablecoins buying US debt, right? So you're essentially turning treasuries into dollars at that point, right? And that could drastically lower rates and maybe even supercharge the world economy in that rate plunge. But then I would also be curious about what happens to the dollar itself. If everybody is buying treasury bills and everyone's getting out of the dollar, is that going to have some kind of weird effect where the dollar goes down, like stablecoin proliferation goes up in some kind of weird balancing act? So I have no idea how to play that out. I just know that infrastructure is going to get built, DeFi and crypto adoption is going to skyrocket. There's probably going to be a credit crunch. And, whenever the dust settles, I think the financial system is going to look very different.
Yeah.
Yeah. Isn't there some, in the Genius Act, isn't there something about that stablecoins can't be yield bearing too?
Yes.
The ones issued by the banks. So that kind of, plays into your hand. How do you guys see that?
Yeah. I think it's no secret that they, the banks probably lobbied for that because they want, the full, the full backing that they're going to use for their stable coins, which is, short dated paper. They want all of that cash for themselves, right? Of course you would want that instead of passing it on to consumers, that kind of thing. Or at least they want to be able to have the optionality to pass whatever they want to pass on at that point, kind of like Coinbase and Coinbase Wallet do. So, yields and, to an extent, BIDL and USDY, everything else that's out there in the yield bearing stablecoin side, that is in direct contradiction. But all of those rails are much, much smaller than the banks have access to, right? And they're all much smaller than whatever's out there with USDT and USDC already. So while I do think, yield-bearing stablecoins are going to be a foil to stablecoins, I don't know at what time frame, what timeline that's going to happen, or I would assume that non-yield-bearing stablecoins are going to proliferate way faster, way wider, and then it'll just kind of be an over time thing that yield-bearing stablecoins take over.
We've talked about stablecoins. We've talked about lending. We've talked a little bit about exchanges. Maybe, we alluded to this earlier, but talk to us a little bit about just the future of stocks and how you see these being on chain one day and how you guys plan on utilizing them or integrating them.
That's a great question. So I don't know if you guys saw Robinhood's announcement about, stocks on chain. And there's been other stocks on chain, X stocks on Solana, that kind of stuff. The way I kind of think about this is there's 3 levels of stocks and equities on chain. The first is just tokenized IOUs, right? They've been around for a while. Bittrex started with that. FTX had a little bit of that. But ultimately, you're not actually owning the stock. And so you can't really arbitrage it. It's just kind of paper trading, right? If FTX goes down, like it did, and you had on-chain stocks in IOU form, those aren't coming back to you, right? Because they're not actual equities that you own.
Right.
And then the Robinhood announcement took it to the next level with something called ADRs and GDRs, American Depository Receipts and Global Depository Receipts, which is essentially when you own those, you do have your name on the registry of ownership, right? A bank essentially holds them in custody for you, but they're your stocks and you get the tokenized version of that, right? They come with most of the benefits, but not all of the benefits. And there's also potentially regulatory issues that come with them. And then there's the last version, which I think is the best option, which I think is going to be what ultimately proliferates, is just having your stock native on chain under a second QSIP, right? A second identifier. That is basically just the same as the original in TradFi. It's completely arbitrageable. You own it. Your name is on the registry, all of that. And it's just basically a covenant between you and the company at that point. And that's what I think is going to happen. At some point, some company is going to go first and put their equity native on chain. And then there's going to be extra liquidity for that stock. People are going to notice it. And then everyone's going to release a second QSIP. of their native stock on chain. And it's going to be crazy not to have your stock on TradFi and crypto rails at the same time. And eventually, I think TradFi rails just end up dying, and then everything just is native on chain at that point. But I would imagine you're going to have a dual listing, two CUSIP system where you have your TradFi native stock and your crypto native stock, and they're just arbitrageable against each other. And that ultimately results in more liquidity for the stock trading.
Yeah. It's interesting to think about, just like with that and with, I mean, even like dollars or, stable coins, where it's like, you kind of that wallet aspect, and that also that finality aspect kind of with, like, all the flaws the current banking system has. One things that's nice is, like, I could call Chase and they could give me my money back.
Yeah.
Where it doesn't really happen in crypto.
That's fair. Yeah. I mean, there are some things that might get a little weird with self-custody and, that kind of thing, but it also unlocks a lot more. Like, imagine you own, on-chain Tesla and you borrow against it. And, you're able to, own Tesla appreciation while also being able to go buy coffee with the cash that you just took out against it, right? Like, you can't do that today on TradFi rails. You can't cross-asset, cross-collateralize, where if you own Tesla and AMD, you borrow against them and you buy NVIDIA, right? Like, and so now you have, the same exposure that you did before, but now you also have another stock. You're leveraging yourself. You could potentially even one day fractionalize your Tesla shares and, sell some of them instead of just having to buy, one unit at a time. And maybe you even can pay your buddy the bet that you lost with him in Tesla stock, which you can't do today. So like a lot of that also unlocks. And so, yeah, I mean, like, maybe there's some weird things that come with self-custody. Maybe there's some solutions with that that come along the way, but the unlocks are just going to be wild.
Yeah.
A lot more potential for sure.
Yeah.
Yeah. It's interesting to kind of compare and contrast the both sides of TradFi versus kind of the new regime, or what it will look like. Because I always forget to think about this, but a lot of times, as we all know, a lot of people have made money off inefficiencies for decades, right? And be able to pull them out of that paradigm into new regime, that tends to be uncomfortable, and people come dragging their heels a lot of times.
I think we're about to see some very strange transitionary times happening over the next 5 to 10 years in finance. And I think once the dust settles, it's going to be a much better system. But that transitionary period might be weird for a little while.
Yeah. Painful for some. Good for others.
Yeah, exactly.
That was
cool. Well, I think we covered just about everything here, Nick. Any final thoughts on your end? Anything we haven't talked about yet?
No, just a quick sales pitch. You can get 9% today on democratized prime, lending out against high credit profile home equity loans. And that pool's filling very fast. We're already up to 12 million. We have another 5 million coming in. And so get going today before supply and demand drives that number down a little bit.
Awesome.
Yeah,
very cool.
Absolutely. Who are the people that you guys want to talk to, and where could they find you guys?
Yeah, I think there's kind of three cohorts of folks here that that product is perfect for. One, people that are firing, right? Financial independence, retire early. They are looking for kind of low risk, high yield opportunities so that they could sustain their lives a little bit better, right? We think the TradFi audience, people that are understanding what a decentralized warehouse line of credit could look like, they're kind of perfect for the product. And then we also think that people that are traders and have idle cash sitting by, don't let your cash sit in 4%, let it sit in 9%, take it out when you want to go buy, a stock or a token or whatever it is. So you guys can find us, download the Figure Markets app in the iOS or Google Play Store. And it's on the lend tab, the 5th tab in the app. You buy yields and you get into the pool and start earning 9%.
That's awesome. Fantastic. Well, this has been a great conversation, Nick. We'll make sure to include all the information with your contact info in the show notes. And like I said, this has been great to have you. Appreciate your time.